Welcome to this explainer. Listen, today we are stepping into a high-energy mentoring session designed specifically for those of you targeting that absolute A-star grade in IGCSE Accounting 0452. I'm channeling some incredible insights today from a subject specialist and a senior examiner to really break down Module 08, Division of the Ledger. And we are moving way beyond basic textbook reading here. We're unpacking the exact advanced technical methodologies, those crucial cause and effect chains, and the strategic secrets that separate the top-tier students from everybody else. So get ready, because we're completely deconstructing the ledger today, turning raw data into your ultimate advantage on exam day.
Okay, let's take a quick look at this A-star blueprint, mapping out our exact journey for the session. We'll hit ledger architecture, method marks, AO3 evaluation, modern fintech, examiner strategy, and finally, a final challenge.
Section 1. Ledger Architecture and Concepts. The Bridge to Financial Intelligence. To kick things off, we need to frame the division of the ledger correctly right out of the gate. You know, this isn't just about tedious record keeping. It's literally the fundamental DNA of a business. And our senior examiner notes a massive, massive shift you absolutely must be aware of to secure your marks. For the syllabus updates heading into 2026 and 2028 through 2030, Cambridge has firmly transitioned to modern international terminology. Consider this your exclusive inside scoop. The days of using older colloquial terms, they are gone. You are now strictly required to use irrecoverable debts and owner's equity. And I mean with 100% accuracy. If you're sitting in that exam hall casually writing down outdated terms, you are throwing away straightforward marks. This updated vocabulary, along with mastering terms like accrued, prepaid, and realization, is your entry ticket to proving you truly understand the modern accounting environment.
And it becomes beautifully clear how deeply intertwined these definitions are with core accounting concepts when we look at the prudence concept versus the historical cost principle. So the prudence concept dictates that we must anticipate potential losses to avoid artificially overstating our profits, right? But why does this actually matter? Well, think about the cause and effect chain here. If you ignore potential loss, say an irrecoverable debt, you inflate your profit. This is not a victimless error. It actively misleads vital stakeholders like banks, who might issue a massive commercial loan based on that false financial health, or tax authorities who base their entire assessments on these very numbers. It's a direct violation of financial transparency.
Section 2. T accounts and method marks. Maximizing your score. Now that we've got the architectural theory down, let's transition into the actual procedural mechanics. The subject specialist walks us through this incredibly strict logic, showing exactly how raw data flows. Honestly, think of it like a giant water filtration system. Raw data flows from the source document, like an invoice or a bank statement, gets sorted in the book of prime entry, purified in the T account, balanced out in the trial balance, and ends up crystal clear in the final financial statements. You must be able to visualize this pipeline instantly. Now, notice where students routinely just hemorrhage marks during this data flow, miscalculating the percentages between trade discounts and cash discounts. Let's ensure your baseline is rock solid here. A trade discount is a bulk reduction in the catalog price, often recorded before it even hits the main ledger accounts. But a cash discount, however, is a reward for prompt payment, and that requires very specific double entry treatment in the discount allowed or discount received accounts. Mixing up the mathematical treatment of these two, like applying a percentage to the wrong base figure, is a classic trap that instantly throws off your entire trial balance. So what actually happens when you make one of those tiny mathematical errors under extreme exam pressure? This is exactly where the method mark strategy saves you. Listen carefully. The examiners are specifically looking for your logical flow. That big T structure is your safety net. If you clearly show all your workings, how you calculated depreciation, how you valued inventory, how you distinguished your balance brought down from your balance carried down, you will be awarded method marks. Even if a totally minor calculation error throws off your final balance, that visible logical T account structure proves your competence and secures those critical points. Never, ever just write down a final number without showing exactly how you got there. Section 3, AO3, Ratios and Evaluation, Thinking like an Analyst. This is the moment where we separate the A students from the A-star students. We are moving beyond basic calculations to truly thinking like a financial analyst, actively debating the cause and effect chains of financial data. Look, calculating a ratio is just a baseline skill. Interpreting it, that is AO3 evaluation.
If the current ratio, which measures liquidity, tanks from a super healthy 2.5 to 1 down to a struggling 1.1 to 1, a basic student simply states, it went down. But an A-star analyst asks, why? Is inventory rotting in a warehouse somewhere, massively overpurchased and tying up cash? Are trade payables being settled far too slowly? Or are vital cash reserves completely depleted due to heavy capital expenditure? Identifying the physical root cause of why the ledger looks the way it does is your absolute key to mastering AO3. We use interfirm comparison to show another brilliant layer of evaluation. Imagine you're comparing the profit quality of two totally different businesses. One uses the straight line method of depreciation, while the other uses the reducing balance method. Because their accounting policies differ, direct numerical comparisons become incredibly tricky. The surface numbers might show one business is vastly more profitable, but as an analyst, you have to adjust for the fact that the reducing balance method front-loads the expense. It takes a larger percentage of the asset's value right out of the gate, which hits those early profits much harder than the steady, flat line of the alternative. And as our subject specialist always warns students, a true A-star evaluation goes even further. You must analyze the invisible factors that simply do not appear in the ledger, but absolutely dictate long-term sustainability and metrics like return on capital employed. We're talking about staff morale, the physical location of the business, its overall market reputation. An immaculate ledger means literally nothing if the entire staff is about to quit or the market reputation is destroyed. Bring these non-financial factors into your written evaluations. Section 4. Modern FinTech and Zero. The real-world application. It's vital we connect all this textbook theory to the real world. How does this manual division of the ledger translate into the modern industry you might actually work in one day? Well, it translates directly into AI-driven accounting platforms like Xero. These platforms instantly automate the duality of transactions. But here is the truly fascinating part. The AI is simply executing the exact fundamental accounting equation, assets equals liabilities plus equity, that you are learning to manually balance right now. When Xero processes the bank feed, its AI engine relies on the exact same principles of duality and the business entity concept we've been discussing. You aren't just learning how to pass an exam here. You are learning the underlying logic that powers multi-billion-dollar fintech software. Section 5. Examiner warnings and strategy, avoiding common pitfalls. All right, let's get tactical. The senior examiner steps in here to deliver a sharp, no-nonsense checklist of recent, real-world pitfalls straight from the 2024 and 2025 principal examiner reports. Year after year, top students lose marks on completely preventable errors. First up, illegible handwriting in ledger accounts. Seriously, if the examiner cannot read your balance brought down, they cannot award you the mark. Second, confusing revenue versus capital items. Treating a capital expenditure, like buying a brand new machine, as a revenue expense absolutely destroys your profit calculation. And third, missing state symbols, like failing to denote whether something is raw material or work in progress in your manufacturing accounts. Ignoring these symbols is one of the fastest ways to lose straightforward marks on exam day. Lock these easy fixes in right now. Now, we all know exam pressure is incredibly real. To combat exam panic and ensure you maintain the accounting equation and core concepts at all times, the senior examiner recommends the PhD memory hack. When you are staring at a complex, multi-step problem and just feel stuck, remember PhD. P, prudence. H, historical cost. D, duality. Run the transaction through those three filters. Does this anticipate a loss? Is this recorded at its original cost? Have I recorded both the debit and the credit impact? This mental checklist will instantly center you and get you back on track. Section 6. The A-star final challenge. Pause and think. We have covered the architecture, the method marks, the evaluation, the fintech, and those crucial examiner pitfalls. Now, it's time to really test your analytical reflexes. We're going to leave you with this final A-star challenge to prove you can connect basic ledger mechanics to high-level financial transparency. Pause and think about this for a second. Trace the exact cause and effect chain. If a business simply forgets to record an irrecoverable debt, how exactly does that specific violation of the prudence concept overstate the profit, inflate the owner's equity, and ultimately lead a bank to make a disastrous lending decision? Can you articulate every single step of that failure? That deep level of understanding is what the division of the ledger is truly about. Thank you so much for joining this explainer, and keep pushing for that top grade.